DeepSeek, a Chinese startup, released a new open-source generative AI model titled R1 at the end of last week. And as markets digested this over the weekend and opened up on Monday morning, the implication of this new entrant, which has shown equivalent performance to pre-existing models, but having only required a comparatively very low training cost to develop, caused many to reassess what impact this potential step change in efficiency could have on various segments of the AI value chain. It's been a very turbulent last few days for the market digesting this, and whilst the true cost of this new model will be debated for some time to come, noteworthy market participants have already highlighted how this surprise enhancement could make AI more accessible and far more quickly than expected for a much wider range of use cases, with Microsoft CEO Satya Nadella causing many market participants to dig into 19th century economics readings to look up the Jevons paradox for historical indicators of how this may play out. It should not go unnoticed that the fact that the competitive threat of a single startup has had such a significant impact on the broader market and caused volatility in many of the very largest companies within numerous sectors, from technology infrastructure through to utilities and energy companies powering it. A further sign of just how concentrated the broader market has become and how sensitive expectations are towards relatively narrow themes at the current time. This builds on the case for maintaining a truly diversified mix of performance drivers within portfolios. This has been a busy week, providing lots to consider, and we were hugely grateful to Stephen Yiu, CIO of Blue Whale Capital, and a fund manager with a huge amount of experience in this sector, for sparing some time to discuss the events of the last few days, amongst other topics. Welcome to the Investor Insights podcast, hosted by Killik Co. My name is Gordon Smith, and in each episode, I'll be interviewing portfolio managers from across the investment industry to gain from their expertise in the specialist areas in which they invest, and to question them on topical issues. You can access the full series of interviews via the playlist on the Killik Co YouTube channel, or by searching for Killik Co's Investor Insights on Spotify, where you can subscribe and be notified of future episodes. We hope you're enjoying the discussion so far, and you can get in contact with us about any of the topics discussed via the email address investorinsights@killik.com. Killik Co is an independently owned wealth manager which opened its first office in 1989 and provides services to help families save, plan, and invest. And you can find more details on the unique ways in which we do that at our website, killik.com. In today's episode, we were joined by Stephen Yiu, the founder of Blue Whale Capital and the lead manager of the Blue Whale Growth Fund. Having started his career at Hargreaves Lansdown, Stephen went on to hold a number of asset manager positions at New Star, Artemis, and Nevsky Capital. And then in 2016, with the backing of his old employer, Peter Hargreaves, launched Blue Whale. Stephen and his team run a single global equity fund, and we discuss some of the key elements of the philosophy behind that strategy in our discussion. Stephen has built up a significant amount of expertise and very successfully invested within the AI-related areas of the market since the fund launched in 2017. And so this was a very timely point to catch up. This interview was recorded on Wednesday, the 29th of January. We hope you enjoy the episode, and as always, please get in contact if you'd like any further detail on any of the topics discussed. Stephen, good afternoon. Thank you so much for coming in and joining us today. How are you doing today?
Very well. Just been quite busy with DeepSeek a few days ago.
Yeah, it's very fortuitous timing of this. There's lots to talk about. I'm sure we'll get on to DeepSeek very shortly. But we've got this kind of standard opening question to these. And what it's designed to do is kind of get a bit to know you and kind of how you go about your work. So I wondered if there was perhaps a research project or something you've read interesting over the last kind of recent period that you could share with us, just to give us a bit of an insight into kind of how you go about things.
So I've been reading a book on Donald Trump, Lucky Loser, but that's not what I'm going to share today. So I have actually been doing some work going back when we first started running the fund back in 2017. And I have been reflecting about what we're trying to achieve. Basically, very simply, that we want to buy companies that can gain a larger market share of the world spending, right? Whether it's coming from consumers or enterprises and so forth. So of course, if I look back in terms of our journey, I mean, we have got some decent exposure to some of these names, and I'm trying to just do a research project to understand like how it all happened on a global basis. So what I did was I downloaded about 3,000 companies of data points about how much revenue they were generating 7 years ago in 2017 versus 2024 last year. And the number at the time was about $35 trillion in aggregate across the 3,000 companies, global listed companies. And last year in 2024, that number went up to about $50 trillion. So the CAGR growth over the last 7 years is only 5%. So it's actually reasonable in terms of real GDP growth, about 2-3% with inflation. So everyone, if growing at 5% a year, then the market share would be very similar compared to 7 years ago. But of course, that's not what happened, right? If you look at the incremental revenue gain, which is from 35 to $50 trillion, that's a $15 trillion of additional revenue. And if you look at who had been winning those market share, the North American companies have captured 50% of that pie. And when you look at losers, most of them would be British or European companies over the last 7 years. But at the same time, if you then look into the sector split within that mix, the 15 trillion gain, the 50% of that, most of them would be big tech companies. So of course, if you think about that today, we are spending a lot more of our time or money living in the digital world compared to the physical world many years ago. That did not make sense. Of course, most of these companies are providing the service are American tech companies rather than European companies. So I thought it was a very interesting exercise just to look back to understand why the US has done very well in terms of stock market at the same time while tech companies have done very well. Of course, there's always a price to pay. Then I think that's the job of an active manager to decide whether the valuation is reasonable or not. But I think from a very bottom-up fundamental perspective, it does make sense that why American companies have done very well in the stock market terms over the last 7 years.
Yeah, absolutely. Yeah, so that explains a large part of the dispersion in returns that you've had. I think we've got a question coming up on valuations, and I think maybe we'll come back and touch on a few of those points you just made. But yeah, they're very very interesting. Thank you for that. Steve, I wondered, just for perhaps listeners that haven't heard you kind of describe the kind of the story of Blue Whale, whether I could just ask you to very briefly, appreciate we've got a lot to talk about in terms of what's happened this week, just to start with, to just kind of frame things, whether I could ask you to kind of summarize the differentiating features of Blue Whale. You often talk about that high quality hurdle that you have. Could I ask you just to briefly explain what you mean by that, kind of what you're trying to...
So within the our investment philosophy, I think on a very high level that we do have a bias investing into quality businesses at an attractive valuation. So the starting point would be that we want to find companies that are of certain qualities. Of course, I think when you look at the different definitions of quality, whether it's good management team, return on investor capital profile, the stickiness of its customer base, good balance sheet, I think we're no different to most other quality managers on that front. But I think what we probably have done a bit better since we started the journey was we managed to find the outperformers through within the mix of quality businesses, right? It's all very good that you invest into good companies that could survive the pandemic, the interest rate increases, the inflation, the conflicts in Ukraine and Middle East. But at the same time, you need to be able to capture more market share of the world spending, right? If you're just surviving those journeys, it's unlikely that you can outperform. But then at the same time, if you are a good company, at the same time, you're capturing more of the market share. So if I look back to the first 4 years of the journey between 17 to 2021, it would be mostly to do with digital transformation opportunities like e-commerce, digital payments, digital advertising, software, cloud, of course, now is become an accepted kind of conventional play because like we're spending a lot of time and money just living in the digital world. So that is what makes a good company outperforming the market or able to capture more of the market share, which is very important. But the unique kind of things that we do, we would think, just because we are running a very high conviction mandate between 25 to 35 stocks, we have five people, including myself on the investment team, and we do all the research in-house. So we will go through all the primary sources of information from annual reports, investor days, transcript conferences, looking at the competitors, annual reports, transcript conferences, to get a conviction on a company that we're investing into, right? And then the other thing is when you think about, oh yeah, there are 5 of us on the investment team, doesn't sound like a big number, but when you marry that with the number of stocks that we cover, on average, every one of us is only covering 5 companies. So that if you're covering 5 companies like full time in a year, like just imagine the level of research or financial modeling, kind of the know-how that we can build throughout that period is going to be a lot more significant versus maybe some of our peer group who might not have that resource or that intensity in terms of coverage. So I think that is a very unique point. And at the same time, I think one thing that we probably have done relatively well too is we would want to navigate the market with the best set of opportunities going forward, right? Like there's a lot of things that we used to do back 7 years ago. We did very well on the back of that. And then we recognized there's a change of a regime in 2022, geopolitical uncertainties, inflation, interest rates staying higher for longer, consumer discretionary being under pressure for much longer, etc., then you need to evolve your opportunity set. So what we did, a few changes in 2022, and since then we also captured the dynamics of AI, which was very new. It didn't happen back in 17. And then once you figured out that, oh, this is the new world, this is where companies going to spend a lot of money, and they're good companies too at the same time. And then you look at the valuation, it looks very attractive to us at the time. And then that's how you then shift your portfolio from one set of opportunities to another set of opportunities, subject to the market environment or where we're heading from here.
Yeah, no, absolutely. That's really useful in kind of framing things. Thank you for that. I mean, it's been quite an extraordinary last couple of days, really. We're kind of talking just a couple of trading days after DeepSeek, that Chinese company, announcing that kind of the news of their AI model R1 showing pretty good performance, but just at far lower cost of training. I mean, given that it's been an area which you've been so successful in investing, big part of the portfolio. Could I ask you to maybe just talk us through your kind of early thoughts of what's been announced on in the market, and everyone is still digesting things a little bit. But perhaps we'll move on to talk about the implications for the portfolio, but kind of general thoughts on the impact on the broader sector.
Yep. So on a very high level, DeepSeek achievement or breakthrough is very positive for the generative AI domain. Because if you look back before DeepSeek's announcement, previously there had been 2 bottlenecks in terms of where we're going to head in terms of AI development. One was the cost and the price, because it's very, very expensive to train a model. And then, of course, then for companies who have spent a lot of money training a model, they will need to make the money back, right? Then ultimately the price that consumer or enterprise user are going to pay is going to be a lot higher. And you might not be able to afford that price, or you might not be willing to pay for that price. So what DeepSeek have done is to lower the cost of training, which means that it's going to be very helpful in terms of making AI more accessible. And at the same time, previously, only the big tech companies, mostly in the US, would have a monopoly access to developing AI applications, just because the entry ticket is about billions of dollars that you need to firstly invest into NVIDIA GPU or doing your own in-house GPU with Broadcom. And what DeepSeek has then done is to level the playing field, that nowadays you can expect many more startups without the access to billions of funding, and then you can come up with a market fit product before you raise the money, right? But beforehand, you would not be able to do anything. So then what it means is we're going to welcome a lot more competitions coming in, which could be disruptions to some of the big tech companies. I'm sure we'll come back onto that later. The second bottleneck previously would be energy consumption, because it has been well covered in this topic that within the existing energy infrastructure, that is not enough to cater for the ultimate AI demand that's yet to come. And of course, when you look at the big tech, what they have been doing last year or so is they have been investing into nuclear energy. So what DeepSeek has also solved in terms of lowering the cost of training the model, that we probably would have another few more years before we saturate or exhaust the existing energy infrastructure. So on a very high level, is very positive in terms of leveling the playing field, at the same time lesser the energy intensity, and then also welcoming more players coming in. And then, of course, it's all going to be very helpful to consumers or enterprise users over time.
Yeah, no, real step change in that. Yeah, thank you for that. I mean, you talked about the kind of the big cap tech. I mean, I wonder if we could talk about the portfolio and how it's positioned in some of your commentary through last year. Really, certainly the latter part of last year, you talked about having made a number of changes to where you're positioned in the value chain of AI, whether it's kind of infrastructure or the applications. Could I ask you to talk about some of the rationale behind that and just whether anything's changed in your view of kind of where you see the kind of the economics of AI kind of playing out over the next kind of phase?
So on a very high level, if I take you back to 2023, we were heavily exposed to AI infrastructure and also AI applications company. So on both sides, right? And of course, as the time goes on, then you try to work out which part of the market would actually become the beneficiary and which part of the market could become the losers. And that's what happened in 2024, that we took the view that we are more positive on AI infrastructure companies such as NVIDIA or Broadcom, who are on the receiving end of any AI spending, right? Because that was a concern at the time that all these big tech companies, the Mac 6, spending a lot of billions, you're talking about hundreds of billions of CapEx to develop some applications that might end up working quite well or might not work out quite well, right? So then that could be some wastage in terms of money. At the same time, the view that we took last year was that the cost that they need to run the application is a lot higher than your traditional Google search or the OneDrive previously, because it's AI's GPU compute. At the same time, you probably cannot overcharge your users because they're not going to pay a high price before they see the results. So what it means for some of these big tech companies, the return on investor capital profile is coming down from here. So if I go back to our valuation framework, that we look at free cash flow yield over the next few years, we make our own forecast in terms of how much money we think our company would deliver. But at the same time, the way to assess whether the valuation is attractive or not is to marry that with the quality of the business. So when I look at Microsoft, let's say today, that is trading at all-time high based on our framework versus the few years before. But at the same time, the outlook in terms of the quality of Microsoft is lesser than before, just because of how much money they need to spend on AI and become a very capital intensive business versus before was a pure software business, right? So there's a price to pay for that. And I think to us, it's a lot more expensive or overpriced for what it is. And so we have a bit of concern. So we have been selling down, reducing our position in Microsoft, and currently is a very small position, just over 1 to 2%. And obviously, if you follow the MSCI World stock market, the market number would be about 4 to 5%. So we're significantly underweight. That could be an opportunity for us to reduce it further or to exit the position, but we're monitoring the development quite closely as we speak. But on the back of this is we are still very much convinced by AI infrastructure, because what is interesting about DeepSeek recent announcement is they have not come out with anything that we haven't managed to achieve in a Western domain. They showcase that you can do it cheaper, which is what China is very good at, engineering rather than innovation. But I think the end conclusion is they still need to run it on GPU, isn't it? Like all this very intelligence development to optimize the algorithm, it was still built on NVIDIA GPU, not something else. So then the achievement or the breakthrough that they have done, if some of the big tech company in the Western domain is going to copy them, they will still be running them on a GPU, or you still need to have your Broadcom in-house GPU. So what is very interesting is like you still need to run your AI application on some compute, right? You're not going to do it on your laptop, for example, to develop some language models. So I think we are further convinced that we need more infrastructure going forward. And the view about AI applications or services company, I think, stays unchanged from last year. And I think I mentioned the points about that there's going to be more competitions. So Google, Microsoft, or like Tesla or Amazon no longer have the monopoly access to develop AI application, that we're going to see more startup coming in, which would be very similar to your smartphone era, that you would have Instagram, WhatsApp, which was developed by some very small companies, right? It ended up being acquired by Meta. And of course now we are using it, but it wasn't developed by Meta in the first place. So we are going to see many more of these coming in, which could be a disruption to the Mac 6 companies.
Yeah, no, some really interesting points in there. Yeah, thank you for that. Could I maybe just pick up on the point you made in an earlier question about AI now being way more accessible, the kind of lower cost, increased competition might pave the way for entirely new use cases. I mean, where does your mind go in terms of where that might be? Are there kind of opportunities that you think might present themselves in the portfolio?
Yeah, this is a very important question in a way that, as far as the DeepSeek announcement is concerned, because if you think, or if your view is that, oh, everything that we've seen to date, let's say ChatGPT, image generation, summarizing an essay, transcribing a conference call real time and all that, that is the end of AI development. I think we probably got too many GPUs today, right? So if that is your view, then I think DeepSeek is actually causing chaos in the Western tech domain. That is not our view. Our view is like we are at a very early innings of the development of AI applications. And one thing that have started to take shape, which is very early in the journey, I would say that is going to be more prominent in the next few years, is called AI agents. So AI agent is completely new. If you haven't followed the space, AI agent is basically an advanced version of an AI chatbot. So just imagine if you go to British Airways now, your flights got canceled, you're trying to work out how you're going to get a refund. You speak to someone online, which would be an AI tool, not a real person. And then they will say to you, oh yeah, you should go to this page, you should send us an email, you should have all these documents attached, etc. But they're not doing it for you, right? And then you try to then, can I speak to someone? And then you have to wait for 30 minutes. And then that person is saying like, yeah, we probably can't do much. Just go back to the website to submit your claim. So what AI agent is going to do potentially is that it's not only just an AI chatbot. So obviously have understood your query about, oh, your flight's being canceled. But at the same time, the AI agent is going to be connected to the backend system of British Airways. Let's say the booking system, the flight scheduling system, the accounting system, to making sure like everything is correct based on what your claim. And at the same time, it can actually give you that refund directly without the influence or interference from a human being. Of course, I'm sure there will be an oversight layer that they're not going to give you more money than than they should, right? So that would be like a approval check. Okay, $250 rather than a bigger number. So if you think about how powerful AI agent could become, it's you and I. We might not be seeing each other in this room doing this podcast today. I could be sending my own agent who would know quite well about the topic, about the Blue Whale strategy, about a lot of things that I've probably mentioned about DeepSeek over the last few days. And you could be also doing another podcast with someone else, but then you are sending your agent. So it's going to be very powerful. And there's a lot of technology that's already going into this space today. And it's not really rocket science. So what I'm saying here, we're not talking some sort of like a Star Trek scenario that this is like 20 years away. Like OpenAI have already started doing it to help people to make bookings in restaurants. So if you send a request to say, can you make me a reservation at this restaurant at this time for 2 people, they can actually do it for you. But at the moment, it's still very primitive because it's not connected to the backend system. So just imagine if I just outlined this one use case about booking or changing a flights or getting a claim from BA, which I'm sure most people would love to have this access to rather than to wait in the line to speak to someone, then that's going to be a lot more use cases. Just think about HSBC, your Boots, your supermarkets. There's a lot of things I can do, and we have not even started that journey. So of course, I mean, the starting point to do all this is you need to have the GPU to learn about things, and at the same time to do the compute when people are actually using the service.
Yeah, no, absolutely. Yeah, lots of applications there. And Steve, I said I'd come back to kind of talking about valuations. I just wondered if you could kind of run us through how you are looking at valuations within your investable universe at the moment. I mean, I mentioned that the first question is kind of a large part of things is that kind of market share and that earnings growth that we've seen from a number of these companies that you've been exposed to. But kind of how are you rationalizing valuations at the moment?
So the way that we go about valuation is we build financial model for every company we have. And of course, we will have our own assumptions in terms of how much money we think the company is going to make in the next 3 to 5 years. So the first part of our valuation exercise is to compare our shorter term forecast versus the market expectations. Let's assume that we are ahead of the market expectations. At the same time, we prove to be right. Then it's likely that you can expect earnings revision upgrades, or the PE ratio that most people would be looking at based on consensus is incorrect, right? Because if the earnings number is higher, which is our job to do, then we could actually be seeing upside potential. At the same time, the share will be undervalued over a shorter period of time. At the same time, on the other side of the fence, if our forecast ended up to be behind the consensus, then if we are right, then you can gauge that this valuation is a bit more expensive based on the market consensus. So you probably don't want to have too much exposure to that, or maybe revisit that at a later time. The second part of the valuation exercise, which I mentioned earlier, is we look at free cash flow yield adjusted for debt over 5 years. So we would also forecast up to 5 years in terms of how much free cash flow NVIDIA, Microsoft, and some other company would generate. And that is also the time that we'll marry the valuation alongside its quality, right? Because like there's a spectrum of good companies. Some of them would be higher quality than another. Let's say consumer staples company are good company, but they're not super high quality, right? And then you have some software businesses that the customer base is very sticky, not so much competition. Then you would probably expect that the valuation would be trading at a premium rather than a discount to just a good company. So then what we try to do is we want to have a diverse mix of opportunities within the portfolio. So not just AI. I mean, we will talk about sports gaming, luxury, healthcare, and some others, and then try to find the best company at a more attractive valuation within those whole cohort and put them together within our 25 to 35 stocks portfolio. And when I look at the valuation of portfolio today, even though that we had done quite well over the last 2 years on the back of a recovery from 2022, that the valuation have actually not gone up. Just because even if you look at NVIDIA, the share price kind of gain over the last 2 years have been below the improvement in earnings or free cash flow for NVIDIA, right? Of course, then the view that you have to take is what is going to happen in the next 3 to 5 years. But at least if you look back in the last 2 years, comparing to the time when we first invested in NVIDIA back in 2021, valuation of NVIDIA today is a lot cheaper than 2021 because it's a lot more profitable, very cash generative, etc. Right? So then actually NVIDIA has not gone more expensive, despite the fact that it's gone up a few times from 2022. So 2021 actually. So that's what we're looking at. And of course, then you try to refresh the portfolio continuously, trying to find the best opportunities with very attractive valuations.
Yeah, thank you for that. And Steve, I wonder if I could get you to kind of discuss some of the other elements of the portfolio. Probably a lot of your time and questions that you get asked is about AI, but you often talk about, as you just have, kind of looking for idiosyncratic opportunities elsewhere. Could I ask you to maybe kind of pick one or two of those areas just to explain kind of what else is in the portfolio?
So yes, we do. So going back to my first research project, like we want to find idiosyncratic companies that can capture bigger share of the world spending, whether it's coming from consumer or enterprises, the cohorts. So one area that has been very interesting to us is US sports gaming. So we have a position in Flutter, and we have done very well on the back of that. And if you follow what Flutter has been doing in the US, so they got this the brand called FanDuel, is that in the US they had never have sports gaming until a few years ago. Okay, in the UK, in Australia, and Europe, we're very familiar with that. In the US, it's never happened before. So it was only about a few years ago the states have started to legalize sports gaming one by one. So if you look at the landscape today, about 50% of the population or the states have legalized sports gaming. So about half of the population have access or they can actually participate in sports gaming. And so firstly, when we look at the quality of the companies, going back to the point about that, it's a two players market, a duopoly. So it's between FanDuel, owned by Flutter, alongside DraftKings. So these two companies control over 80% of the market share across so many states that already legalized sports gaming. Of course, there's a barrier to entry, the brand awareness, etc. Right? So then it's very difficult for new entrants to come in to take share from them. So it's a two players market, which makes it just like anything else. And then secondly, when you look at the size of the sports market in the US, it's significantly bigger than the European sports market. At the same time, when you look at the GDP per capita, it's a lot wealthier in terms of American consumers, right? So then we know that they love the sports. We know that they are wealthier. They could actually participate in this. So the size of the pie is actually very big. When I look at the revenue, going back to my research project at the beginning, between the two companies, the revenue is about $20 billion today. It's growing very fast in the US, but but this $20 billion is after they pay out all the winnings, right? These are the money that they kept or keeping on the back of people losing money, right? So the money is coming from somewhere. So then the question for people to ask is like, where this money come from? I don't actually know. That's the answer. But it's probably come from people who have gone to fewer times to a restaurant, or maybe have ordered fewer things, or maybe have skipped a holiday, or maybe have bought fewer things from Amazon, etc. Right? That's how you get that money. Is always a zero-sum game, isn't it? So then, but this is very good for us because we like the idiosyncratic nature. It's not dependent on Trump because it's done on the state level. And then secondly, it's a new opportunity that hasn't existed before. So this is new, and then it's going to get more traction over time. And if you follow the development, it's actually very exciting. And then it's not very it's not being impacted by what's happening in the world. For example, the conflict in Ukraine or some other things that we're looking at today. So then this is something very interesting, idiosyncratic, completely different to AI, which we also like. And this is why we have such an opportunity in the fund.
Yeah, no, you can see how that's very, very lowly correlated to a lot of the other things. Yeah, for sure. And I mean, Stephen, we were speaking, I think, a week or so after the Trump's inauguration. I wonder whether there were any. I appreciate you're very much kind of bottom up stock pickers, but is there any kind of takeaways that you have from the new Republican administration and the impact that might have on some of the things in your investable universe?
So in terms of our positioning, that running into the election, we were indifferent to Trump or Harris winning. So we haven't actually seen any kind of benefits or impact on the fund since Trump was elected. And of course, I think what we expect is going to happen in the next couple of years, which I think it will play into the strength of an active manager who is running a high conviction mandate, who actually probably know their stocks better than the market, is that Trump is going to create a lot more headline volatility in different sectors or companies, right? He could easily make a comment to say we are going to impose a tariff, or maybe to force certain companies to do certain things, which then when you look at the share price, is probably going to get impacted on that day when the headline comes out. But when I say it's going to play into the strength of active managers, is because if you have done the work, you know the dynamics behind the scene, and you can actually make a decision real time to see whether that might be an opportunity to buy more of those shares, assuming that it's not going to be a material impact, and at the same time you can work out how quickly those impact would be, right? He would only have 4 years to run. If he made that comments 2 years on, maybe he hasn't got the time to get it signed off, etc. So I think it's going to be very interesting. But of course, at the same time, you probably don't want to have too much exposure, right? You don't want to be dependent on Trump because, as we all know, he could change his mind quite easily. And a lot of things that he could be pushing now, he could easily just turn it back when things change for him. There's a lot of negotiation tactic built in terms of what he's trying to achieve for the American. But one thing that we do know, though, is it's going to make the world a lot more difficult outside of the US, right? Is to protect American interests, which I'm sure European countries would do the same, Asia would do the same, and it's not good for majority of companies. So you are if you are exposed, let's say as a company, exposed to all these like geopolitical dynamics about whether Trump is going to impose a tariff, whether you need to shift your manufacturing base away from Europe, going back to the US, it's going to be expensive. It's going to take time, and there's a lot of moving parts that you might not want to do. So then, what we're trying to do is probably just to avoid those companies or sectors that is likely to be impacted, and they might not be able to move too quickly. And at the same time, trying to find opportunities that could be a bit transcendent on the back of that, right? So I mentioned US sports gaming is unlikely. Trump would be able to to impact the sector. At the same time, I think some technology company could be interesting too, like AI infrastructure. I think Trump would probably see this as a national threat from DeepSeek, which is which is a Chinese company, that he's actually made a comment this week to force the US big tech company that you need to get your act together. Like, we're under threat here. So then what you can expect is more money is going to get invested within the AI domain to maintain the lead over the competitors.
Yeah, absolutely. Yeah, some important points in there. Thank you. Stephen, just with the brief time we've got at the end, we've got a kind of standard closing question to these as well, and we tweaked it slightly. We often ask people for their kind of highest conviction area, and you've mentioned a lot of companies and areas already, but an alternative to that would be a kind of management team within your investable universe that you think kind of typifies what you're really looking for from a company kind of steward. Is there one particular area or company that you'd highlight?
Yeah, so on a very high level, if I look back on the journey and also looking at some of the opportunities that we are running now, we do end up investing more into American businesses. I mean, that was not my design because we run a global mandate, but if you look at the average US companies exposure in the fund over the last 7 years, I would probably say it's over 60%. At the moment, we're about 70. And I think one of the reasons, apart from the dynamics of US companies that are actually capturing more share of the world spending, at the same time, the management team is very important. And of course, when you look at some of these CEO like Jensen Huang, NVIDIA, of course, I mean, everyone would follow him quite closely now. But at the same time, like Nadella, we used to have a very large position in Microsoft. Zuckerberg, we still have a small position in Meta. And some other names, like there are many other names like Salesforce, Benioff, or Reed Hastings at Netflix. Is these people, I mean, they are very successful to start with. They are quite wealthy. At the same time, I think even including Elon Musk, that we do not invest into Tesla, but then you have to give it to him that he's still working really hard to make a difference. And typically, you probably don't find as many of those kind of management team or CEO or co-founders in Europe, right? Like a lot of management team in Europe, I'm not saying whether it's a good thing or bad thing, but it does maybe make a small difference, is they are just a professional CEO, right? Like they probably want to like do a few things here, make some money, and then probably do something different completely. But the commitments that you can see from some of these US tech companies in particular that have actually changed the world in terms of the landscape is they are very committed. And despite the fact they're already very successful today, they still want to keep going, right? Like what is the incentive for Sam Altman to keep like, I don't know, expanding OpenAI footprint, for example? I think there's a lot of learnings in terms of that they're not actually stopping, they are not resting on their laurels. And I think that's what you want when you invest into a company, or maybe when you even invest into a fund. Hopefully, maybe Blue Whale would be one of those, is you want the manager to be forward-looking. You're not stopping. Yes, we have done well in the last 7 years, but that is history, right? You're not getting any of this if you're not an investor. It's the next 7 years is important. So you need to keep moving, keep learning about new things, keep making sure that you remain competitive. And I think there's a lot of learnings from some of these American CEOs.
Yeah, no, absolutely. Yeah, really, really important point. And Stephen, thank you so much for coming in, particularly on such a busy week. I really appreciate your time, and thank you.
Thank you very much.
Thank you for listening to the Investor Insights podcast, hosted by Killik Co. You can get in contact using our podcast email address, investorinsights@killik.com. For more information on any of the topics discussed, or for further details on the services offered by Killik Co. This podcast is not personal advice. The content is intended for educational purposes only and is not investment research or a recommendation to buy or sell any financial instrument or product, or to adopt any investment strategy. The value of your investments can rise as well as fall, and you could get back less than you invested. Past performance is not a guide to future performance. The investments referred to in this podcast may not be suitable for all investors, and you should seek advice from a qualified investment advisor. Killik Co is authorised and regulated by the Financial Conduct Authority, the FCA.